On the court or in the markets, performance is everything. That's why Anzo Capital is helping to power your trading game. Now official partner of the Phoenix Suns.
Hi guys, welcome to today's webinar. My name is John, Senior Market Analyst at Anzo Capital. Welcome. So today we're going to go through something that I developed for myself as when I was, or still am technically, a retail trader. So we're going to go through something that I have coined the WCS method. Now that stands for why, conditions, and strategy. And the reason why I created this was to have some kind of direction. And it's really, it's really easy these days to open up a chart, go to that chart, place some technical analysis on it, and assume what's going to happen. And that is exactly where I started. So just to kind of take it back to John, circa sort of 2016, 2000 and maybe even 2015, what I used to do every single day was come to my chart. So here we have charts, and what I had on the chart was a 50, 200 moving average, and I also had a 20 moving average on the chart. So we'll just pop in another exponential moving average here, and let's just adjust that. And what I would do every single day is come to the chart at close. So for me, that was about 10 p.m. GMT. I'd open up my watch list and I'd just go down every single market, right? Like this, just keep clicking down, keep clicking down, keep clicking down. And what I was trying to find was markets that were trending, markets that were creating a particular setup. Now at that time, that setup was really simple. It was the 20 moving average, okay, as my slow moving average. That one there had to be below the 50 and below the 200 if I'm looking for short trades, very much like you're seeing here. And it had to be above when I'm looking for long trades, right? And what this was trying to do was to try and use moving averages as my tool, as my visual representation of being able to see opportunities. And what I would do is I'd wait for the chart to create this sort of pattern here. And all I'd be looking for is a pin candle closing above the 20 moving average. So for instance, we have a bit of a kind of like engulfing candle here. That would be a buy order for me. I'd place a buy above the high, stop loss below the low, and I'd look to try and target a 2-to-1 risk reward ratio. Okay, that is what I would do. And the reason why I did that is because that was what I was taught. I was taught that this is a strategy that makes money. This is a strategy that over a long period of time will make money. And it did. In my first year, I had 33% profit that I made, which technically for a beginner was pretty good. The drawdown was very minimal. I think the most losing trades I had in number row was about 5 or 6. So it was a strategy that was okay. The problem with that is it wasn't enough. And as a retail trader, you will understand this. It's not enough. You want to be a little bit more active, or you at least feel like this is not just it, right? And that was definitely how I felt anyway. I felt that there just wasn't enough. There wasn't enough information. You know, these markets are, you know, a $1 trillion industry. It's not just going to be, oh, here's some moving averages, here's a setup, take a trade. That is one part of the equation. And that I determined was, okay, well, that's just a strategy. That's just someone's strategy that they've given me that I've taken on board. But how do I make that strategy more efficient, right? And it always comes down to where the conditions are based. Okay, what conditions allowed me to use this moving average strategy? It was trending conditions. So my job turned from being the guy that would sit here, go down these charts, looking for opportunities every single day, looking for these markets to set up in a particular way, to understanding that actually I need to be looking for a trend. My job is to find the trend. How do we find the trend? Now we can look at that from a technical perspective, higher highs, higher lows, create an upward trend, lower lows, lower highs, create a downward trend. And we'll discuss this in a minute. But what drives a trend? How do we even come to the determination that a trend is going to form? And there are multiple factors that we can bring into this. But that's when I started to go down the rabbit hole of fundamental analysis. I wanted to understand what was driving price to do a particular thing. And once I understood that picture, it allowed me to build this system and put it into place. So let's go take a look at that system in a little bit more depth. And I've got a few examples that I can show you. So you can see I've just put a little hello in there. I'm hoping that being able to draw on my iPad here will allow us to kind of break this down as well. So I'm just going to get rid of that. And apologies as well. I am still recovering from a cold, so I will try not to cough too much down the microphone. Right, so what are we looking at? We are looking at a method. We are looking at why the market can move. We are looking at the conditions of that market. And then we're going to look at applying a trading strategy. Okay, and this is what it's all going to come down to. It's going to come down to these factors. And the why is something that's super important in this equation. And it's something that, as a retail trader, we don't really catch on to the why, I feel, way later down the line. Everyone starts here. This is the starting point for most retail traders. Okay. And the reason being is because that's the easy part. That is the easy part of finding a strategy, right? It's about, there's loads out there. I can name a few. You can have a look at ICT concepts because that's a big one. I know that's out there. I don't particularly believe in those, but there's something that you can there. You can look at moving averages, strategies. You can look at buying from high or selling highs and buying lows sort of things. So you can look at highs and lows. You can look at things like, the open range breakout strategy. These are all just strategies. That's all they are. They still need something that allows them to run efficiently, or at least run in an environment where they're going to be best to perform. Okay, so for instance, what is an orb strategy good at? Well, it's good at a break and retest, right? In my opinion, anyway. So really, in that environment, you want something that's trending. You want something that's going to be trending. And honestly, I would say probably 70 to 80% of strategies out there rely on trending markets. Right? That's what it relies on. So if we're relying on a trending market, we need to understand what a trending market is. And like I've kind of alluded to earlier, conditions come in all sorts of sort of forms. And really speaking, we have sort of, I would say, 3 forms, right? We have a upward trend. Okay. So that is the market which is making higher highs, okay, and higher lows. In particular, I would be very focused on the lows. Okay. As long as the lows are getting higher, I kind of want to be in that sort of bullish move. Okay. When the higher highs do start to fade, that is kind of like an early sort of warning of exhaustion, but we can often get sort of moments where we have these kind of squeeze patterns and then the market goes again. So for me, I like the idea of checking out the higher lows. As long as they stay intact, usually the trend will stay intact as well. So this is an upward trend. And this is something you're probably already very familiar with. Okay. So what else do we have? Well, we also have a downward trend. What does a downward trend consist of? That consists of lower highs and lower lows. So lower high, low, lower low. Okay. Again, in a downward trend, for me, keeping an eye on our lower highs is going to be super important when it comes to identifying what kind of trend we are in. Are we in that downward trend scenario? If that starts to break out, then the likelihood is the market's going to trade a little bit higher. Again, very similar. If we do start to see a bit of kind of like exhaustion, then the market may start to prevent itself from making those key lower lows. But obviously, you know, we'll talk about that as well. We're going to take a look at some live examples here. Okay. And then there's the final one. And this is the one where a lot of traders lose a lot of capital. It's in the range, right? And the reason being is because a lot of traders aren't particularly looking at ranges, but ranges are just when we kind of get equal lows and highs. And usually it's formed typically from at least 2 highs and 2 lows. And what traders can look to do is kind of sell from the high and buy from the low. Okay, but it's really important to understand what kind of trading condition we are in. Okay, especially when it comes to the WCS method, because it's really going to help us develop when to apply a strategy. Okay, so let's just say, for instance, the downward trend, right? We look at the downward trend example here, and we see that the market is making lower lows and lower highs, right? Let me just actually delete some of that. Let's draw that in. Let's draw it in properly. So we've got lower highs, lower lows. Really speaking, I want to start getting short around these levels, right? Those previous swing points. How do I do that? How do I get involved with that? Well, I usually go down to a lower time frame and look for changes of trend. So let's say this white line that we see here, that is the sort of 4-hour time frame, right? And then we've got the circular, or we'll look at the yellow line as sort of the 30-minute time frame. Okay, now within that you'll get a trend within that area. Okay, so usually we have this kind of situation going on. Okay, so what I'm typically looking for at these particular turning points is some kind of change in that trend condition. So usually you'll go from a lower time frame kind of uptrend to a lower time frame downtrend, right? And that's the stuff I want to try and take advantage of, this kind of initial break here with a move to the downside. Now, a lot of this can come down to sort of chart patterns as well. So sometimes when you kind of look at these in a little bit more depth, you'll see sort of like a head and shoulders pattern, for instance, right? Or you'll see some kind of double top pattern. Okay, so usually you'll see some kind of chart pattern forming around these highs, and that's how I look to get into the market. Now, the strategy that we'll apply, and I'll show you later, is just looking at those kind of intricate parts of it and trying to get on the back of it in continuation patterns and stuff. So we'll have a look at that as well. But that's why this is an important feature of the WCS method, right? Because it's about finding that trend in market. Now, the why can be a number of different things. Okay, now I'm going to show you some today that are really easy, and I'm going to show you some today that are a little bit more difficult. And I don't say difficult as in difficult to understand. They're just probably a little bit more advanced in terms of terminology and a little bit more advanced in terms of methods. Okay, so the first one that I think is super easy is currency strength and weakness. Okay. And why do I say that's super easy? Because it's really easy to find a currency strength meter out there, right? And it just basically tells you that one currency is stronger than the other. To give you a bit of an example of that, this is my personal currency strength meter. This is something that I developed myself. And you can see here, dollar was the strongest currency of last week. New Zealand dollar is the weakest currency of last week. Now, in theory, right, that means I should go to the New Zealand dollar chart and I should sell it, really. I should be looking for at least opportunities to sell it because the dollar is stronger than Kiwi. Obviously, it's not as simple as that. And that's why I say this is like the easiest one to look at. I could look at other features in here as well. I could say that, the euro is getting stronger, the pound is getting stronger. And from the board here, I can see that the Australian dollar is getting weaker and also the Canadian dollar is getting weaker. So maybe I could go and take a look at something like pound against the Australian dollar for potential long opportunities. So there's a lot more nuances to a currency strength meter, but I still feel like this is a good thing to look at, especially if you're somebody that has not gone from just looking at trading strategies. You need to kind of add a little bit more of a why into the mix. So the first and easiest one, like I said, is a currency strength meter. It tells you what's strong, what's weak. Try and pair those up together. Try and trade that. The second one, which I really, really like, is something called the Commitment of Trader reports. Okay, so COT reports. Now, these are something that derives from the futures exchange. Okay, so the Commitment of Traders report is just a report that has to be submitted every single week to the Chicago Board of Exchange. And what it is, or the Futures Commission, and essentially what it is reporting on large trades within the market in simple terms. And what that allows us to see is how institutions, how businesses are using the foreign exchange market or other markets as well, because that includes metals and energy and grains and things like that. So it shows us how they are positioning the market, and it kind of gives us a couple of different entities. So cut reports, to me, give you something called the commercials. Okay, now they are hedgers. Okay, so they are doing the opposite of what current price action is doing. And then you have what's called the non-commercials. Now they are trend followers. Okay, and I can dive into the Commitment of Traders reports and stuff like that in a different kind of webinar. But in short, what we want to be trying to do essentially is following the trend followers because they are large institutions that are trading to make money. So you want to kind of follow those. What I really like about the COT reports is something called COT Extremes. And that is something that's a little bit more in depth, but I will go through a couple of examples of that. Another one that I really like as well, just kind of bring it down here a little bit. Seasonals. Love, love, love seasonal analysis. I actually think it's a very underrated use of a tool. One of my favorite traders, Brent Donnelly, he looks at seasonals and he even has a book that you can buy from sort of Amazon or from himself, which is a diary. And as you're kind of going through your trading journal and diary, it will have a little note on that page saying, X seasonal play could happen within the next couple of days or whatever. And basically what seasonals are is it's an average of what's happened over a certain period of time. And it takes those averages, plots it onto a chart, and kind of shows you what usually happens over a 20-year period or a 50-year period. And there's some really interesting analysis that comes with that. So I know typically in April, the pound performs really, really well. Now, again, that could come with some couple of factors. The tax year in the UK kind of starts in April, ends in April. So there's a lot of things to do with accounts and stuff like that. So usually especially over a 20-year period, there is a 75% chance that the pound will rise in April. Now that can be a very useful piece of information. It can be like, okay, well, if that's the case, is the market currently following that kind of seasonal pattern? If it is, what do I need to see in terms of conditions to find that out? And how can I apply my trading strategy? So that's how we're going to start thinking in this method. The last one, and arguably probably the most difficult to grasp, is macro. And what do I mean by macro? Well, macro is anything to do with economies. So you've got sort of GDP, you've got unemployment or employment, which are the two big ones. Obviously, inflation. And then that's obviously governed kind of by central banks. And that's really what the macro is all about. It's about how the central banks coping with inflation and coping with unemployment. GDP is kind of like a product of all of that. And that is almost like the thermometer of a country. Okay, so GDP kind of shows you how hot or cold an economy is running. Unemployment is a byproduct of that, because if unemployment is rising, then the economy is probably not doing that great. Inflation is another kind of byproduct in terms of if inflation is high, then it can have a knock-on effect on employment and also a knock-on effect of GDP. So a central bank's sort of mandate is to control these two factors. Okay, it's all to do with what's known as price stability. Okay, so that's what I mean. There was kind of like different variations of the why. So you can start off being sort of very, I would say easy, looking at a currency strength meter, very easy to open this chart up here, go and have a little look at different individual things. So I could go take a look at the pound, for instance, against the US dollar or the Japanese yen, and have a little look at how those two are going against each other or with each other. I can see here from sort of the 8th of December, the pound was stronger than the US dollar. So, I could look at potentially going long around that period of time. Or I could look at some other things as well. I could see the US dollar was pretty strong between sort of September and December of 2025. So I could potentially look at selling pound around that time. So that's kind of a very easy variation of that. You then have something called the commitment of trader reports, which then can come in all different kinds of formats. So this is one that's provided by a company called Markets Made Clear, which I have a very good relationship with. And this shows me something known as extremes, and shows me how sort of non-commercials are positioning themselves in the markets. We then also have seasonals, again, built in kind of the same platform, where we can look at seasonal analysis as well. And then we have the macro. So that comes down to something like looking at a news squawk, right? Digesting that information, having a look at an interest rate probability tracker, and also maybe even looking into your economic calendar, where you can look at those different opportunities within the markets based off of key important information that has an impact on inflation, unemployment, and GDP. So that is the kind of the why. Then we look at the conditions, and then we look at a strategy. Okay, so let's go take a look at some examples. Okay, because I don't want to bombard you too much with the nuances of the why, but I think it's going to show you a very important detail, right? So let's go take a look at a chart that I was very how do I say it, very open about on previous channels, as in I was talking about getting short pound Aussie for a while, and that's in any kind of, if you look at any kind of Anzo communications, from sort of November onwards, I was very much looking to sell the pound against the Australian dollar. Okay. And why was I doing that? Right. Let me just move this out of the way. So the reason why I was looking to sell the pound against the Australian dollar came down to a couple of things. So first of all, like I was saying earlier, it came down to the macro. Okay. Now, the Great British Pound, the central bank of Britain is called the Bank of England. Okay. And the Bank of England were very hesitant to cut interest rates, but were very much on the edge of cutting interest rates. Okay. Now, usually when a central bank wants to cut interest rate, or forward guidance at least suggests that they're going to cut interest rates, that currency can become weaker. And we'll talk a little bit about this and how it's impacting current price action as well. And then we have the RBA, so the Reserve Bank of Australia. Now, in Australia, inflation has been pretty high, pretty sticky, as they call it. And one thing that the RBA wanted to do was to try and get a grip on that. So what they did is they hiked interest rates. So they are making the economy a little bit tighter. And the reason they are doing that is because it's running hot. Okay, so inflation is higher, unemployment rates were falling. So that just basically means that people have more capital and they're willing to spend that capital in the economy. What happens then is prices start to go up, demand starts to go up. That is then directly impacting the likes of inflation. What a central bank's tool to kind of bring down that inflation, because they don't want prices to kind of go out of control. They don't want it to grow faster than wages, is they will hike interest rates. And basically borrowing costs are then higher. So businesses or borrowing costs are higher, debts to repay are also higher as well. So it's harder for a business to expand in those conditions. So what we'll typically see is investment into what's known as bonds, okay? Bonds and bond yields. So the yield is basically the return on what a bond is going to give you. And usually bonds will sort of give you a higher yield as it goes down, right? So what happened in this particular situation was, I'm just going to open up another chart. So at the top here, we have a chart, which is the pound 2-year bond yields, or known as gilts, but just for argument's sake, they're bond yields, versus the Australia 2-year yields. And what this is showing us is that the Australian yields were higher than the pound yields. And as you can see, price follows this pretty closely, right? So you can see that when we saw this kind of sideways price action here, that was also reflected in the bond yields as well. We then had a breakout of those bond yields, which kind of corresponds with this breakout of the trend here, okay? So this is where it piqued my interest. We started to see the Australia 2-year yields get a lot stronger than the pound, right? So I was interested in buying Australian dollars, but what did I want to pair it against? Well, I wanted to pair it against the pound, right? So what we can do as well is we'll have a little look. I just want to see how the currency strength meter fared in this situation. Okay, so here we have the pound versus the Australian dollar. And what we can see is the Australian dollar from kind of October, which is the green line, starting to push higher. Okay, and we had the pound, which on average was starting to sort of drive lower. Okay, it did obviously have a little bit of a rebound through this area, and both of them were kind of tracking in that. But then you can see kind of the Australian dollar strengthened or continued to remain strong while the pound fell away quite quickly. Okay, so from a currency strength meter perspective, they were both pretty aligned at that point. However, there were moments where you could see that. So, especially October to December of 2025, and then start of February. Okay, currency strength meter was saying that we should sell. So going back to the chart then, so that was that period here, right? So if we look at October to sort of December, that was where it was saying that we should sell pound against the Australian dollar, and then also February to kind of current prices as well. So currency strength meter lagging a little bit behind from the macro story. Okay, so another way we can kind of picture this is if we go to, so you can have a look at interest rate trackers and kind of or interest rate probabilities of what could happen next. Or you can go to something called trading economics. Okay, and what we can do at trading economics, if you come to the first page here and scroll down, it gives you the entire sort of story of an economy. So you've got here United States GDP growth, interest rate, inflation rate, jobless rate or the unemployment rate, government budget, debt to GDP, and the current account, as well as the population. So what we can do here is come down to the likes of the UK, come down to interest rates, okay, and we can see that they have been dropping, right? They've been dropping since September of 2024, kind of held recently. Now, what we can also do is compare another countries. So we could go to Australia, scroll down and come to interest rate, and we can just click that onto here. And as you'll see, what we've seen recently is from February January to February's meeting, the RBA, which is this grey line, have started to hike interest rates, right? And what you can see from the UK is they have just kept their rates steady, okay? They've held interest rates, and they were no longer looking to cut interest rates, essentially. So what we had was an RBA which was holding rates, okay, for a significant period of time because inflation was sticky, but you had a Bank of England who were cutting interest rates. So they cut like 25 basis points in August, 25 basis points in December, and then they've kind of held at that level now. So you've got two kind of central banks doing the opposite thing to each other. What does that create? Well, it creates that chart here with the yields, okay? Because bonds are basically expectations of interest rates. And as this market started to go down here, we can see that we had this move. So this is the why. The why did I want to get short pound versus the Australian dollar? Well, it was because bond yields were doing what they were doing. It was because interest rate expectations from the Bank of England were dovish. Interest rate expectations from the RBA were hawkish. Simple as that. What can we do in that situation? Well, then we need to look for the conditions of the market to match up with that. So when we look at the conditions here, the market is making lower lows and lower highs. After this kind of breakout of this range here, we can see lower high, lower high, lower low, lower low. Okay. Then we had this pattern form, right? And I actually talked about getting short here, pound Aussie, in some of our communications that we had to our clients. But essentially what happened was the market was making lower highs into this area, formed a bit of a base, right, at this point. So what we were really looking for was shorting into this low and then watching for breakouts to the downside. And how did we trade this? So first of all, one strategy that I like to use is going to a lower time frame and looking for breakouts. Okay, so the first trade was around here, up towards this level here, and I looked to trade down into that level, and then price broke, so I'm looking to kind of breakout trades. Okay, so one trade was a breakout here. The next trade was this. Look, we're below the 50 moving average, which means I want to be on the short side of the market. Okay, we can see that the market is making a pattern, breakout of that pattern, I'll go short. Market's made another pattern, break out of that pattern, I go short. Market's made another pattern, break out of that pattern, I go short. And you can continue to do this as long as the conditions remain intact. Where do those conditions change? Over here. First warning sign here, because we're kind of breaking back above the 50 moving average again, but we dip again. And then we start breaking above the 50 moving average again here. And then we start really kind of advancing higher at that point. So around this kind of area, around these kind of prices, the market is starting to kind of feel that, you know, maybe this run that we've been on is over. And we can see that that's what's happened. Prices kind of pull back a little bit now. Because just because two central banks are doing two different things doesn't mean this story is going to last forever. You know, you have to monitor what the changes are. But essentially, you can see, if I just take off all these trades, what's happened on the daily chart is big move down. That's just a retracement on the daily chart. Boom. 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 Right. Retracement, and then it changes. So there's the kind of condition to say, yeah, let's get out of this move now. But that's as simple as it can be. It can be, why are we looking for that move down? Do the conditions align with it, which it does? And can we take a trade from that? So there was another market trade. Well, there's two recently. The Australian dollar short from up at these highs here was one that I quite like the look of. But also there was a opportunity when it came to some community trader stuff. So this was a trade I took back in 2024, and it was a pound Swiss short trade. So why was I looking to get short? Really simple. So I'm going to come over to the commitment of trade reports. I'm going to show you this one. So here is the British pound sterling futures contracts. Okay. And what I'm going to do is going to open this up, and I'm going to show you how Markets Made Clear kind of present this. So what I typically look for is something called an extreme. Okay. And that's when a certain kind of thing has sorry, a certain kind of statistic has happened. So it could either mean that the hedge funds have reached a position that we haven't seen for a long period of time, or it could be that they have, you know, they're extremely short or they're extremely long at some point. Okay, so what we have here, I'm just going to turn this over a little bit. So I want to put the non-comp positions in. I'm also going to change this to the non-comp index. Okay, so what this is showing us, I'm just going to turn off the long and shorts. So in that period there where we were looking at pound Swiss, this was July of 2024, we can see that we have an extreme long position being built by the non-commercials. So what does that mean? It means they are long. They are aggressively long at these levels here. Okay, so I want to start looking potentially for reversals at that point, because they are at an extreme. They're at an extreme level of positioning. Okay, and we can see in the past, when we get to these extremes, the market can continue higher a little bit, but usually we get some kind of reversal happening. Now, we're never going to know how aggressive that reversal is going to be, but this was one where we had a very strong sort of signal. So you can see, didn't technically reverse for a little while, but I'll show you the other side of that market as well. So that was an extreme on the pound side of things. But what about the Swiss side? So if I open up the Swiss franc as well, we had a very, very similar situation going on in Switzerland. So I'm going to turn this again, 18-month non-com, and we're going to go to non-com positions here. And I'm going to turn that down. So again, you can see July, around sort of the July time, 2024, we had non-commercials, that's trend traders, aggressively short. And you can see that from the net position in here. We hadn't seen positions like that in a very, very long time. The last time we saw positions like that was down in and around these areas here, even sort of around these areas here. And we can see that actually this one in particular, although it didn't give us kind of like the full signal, we had that really strong reversal from there. Here we had a little bit of a reversal pumping up to the upside before a continuation of that kind of downward trend. But this is a weekly chart, so that was like 7 or 8 weeks where price was doing that price action. So this is another way I like to use this. So in 2024 we had a sort of signal, okay, which was these ones down here, right? It was the fact that price had reached an extreme to the short side. So basically saying that trend traders are aggressively short and they're at levels we haven't seen for a very, very long time. So what that means to me is that if they were to get out of those short positions, it could become an unwinding very, very quickly, like you see here. And again, this is a weekly chart. So that's going from, what's that, July, just before July, so June, all the way through to September, right? So that gave me an opportunity because I had one side, the pound, extreme bullish, and then I had the Swiss franc, which was extreme bearish. So if those roles were going to be flipped, then I want to sell pound, buy Swiss francs. Okay, doesn't mean go to that chart and do that straight away, but we can begin to look for the conditions for that to evolve, right? We can see that pound Swiss was in a strong upward trend. It was making higher highs and higher lows. I had a little bit of an early breakout here, but then price rallied again up into this sort of supply zone. What happened from there was we had a really nice rejection, and I've put a line in there just because that's where the plan started to come together for me. But you can see we had like a bit of a head and shoulders pattern here. You had that kind of left shoulder, head, right shoulder. Again, why these chart patterns are quite popular is because you can see them at certain points. So I ended up selling on this breakout here, and I also sold on this breakout here. Again, very similar to how I was talking about pound Aussie. Look at what happened here. Daily chart. Okay, so we're not talking 15-minute short trades here. We're looking at decent sized trades. Daily chart, pullback, breakout of that daily chart move, boom. Pull back on the daily chart, boom, look to get short. And that was a very nice short position. I actually didn't take as much money out of this as I should have because I married the trade a little bit too long, and I held and gave back a lot of the profits because I ended up taking profits around here. But that initial run there, beautiful move down. And it was all to do with trying to find the why before going to the chart. Now, I just kind of back this up a little bit. This is a chart of dollar yen. This is the 4-hour chart of US dollar Japanese yen. Okay. And this is from a company called the Adamas Principle. This is from a trader called Adam Gorzozi, who has been in the markets for a very, very long time, has been a very successful trader on floors and stuff like that. Now, he put this up last week when I was in a webinar with them, and look what he's doing. And again, this is to kind of just give you a little bit of the why. This is called chart mapping, okay? So what he is doing is he is adding in little arrows with events on where the market has kind of reacted. So we can see here, for instance, oil surge. How has that impacted the dollar yen 4-hour chart? Well, we actually saw a little bit of downside from dollar yen, okay? Oil drops to $87. We start to see a little bit of a rally back in that dollar yen price. Trump 48-hour deadline tweet, boom, big move to the downside. Trump peace tweet, market moved higher. So again, if you're looking at kind of current markets and what's been happening recently, it's really important to understand why the markets are doing a particular thing. Now, let's have a little talk about what's going on recently, because if we have a little look at oil prices, they've been pretty chaotic, right? Oil prices have been swirling around. So the market can also be, if we go back to the whiteboard here, and if I just grab the pen, another kind of why, right? can be geopolitics. Now, that one is super difficult to understand and to wrap your head around, because that is basically, recently anyway, that is basically just Trump tweeting, making announcements. We call it tweeting, but Twitter doesn't even exist anymore. But he's kind of just stuck with us. But yeah, or Truth Social posts, whatever. But basically, the why markets have been moving recently is all to do with the geopolitics of the US-Iran war. So what happened was, obviously, US have been bombing Iran alongside Israel, largely due to the idea that Iran has the ability to create a nuclear weapon, which Donald Trump does not want them to have, or America does not want them to have. So that is part of the argument. What happened then was, obviously, the Strait of Hormuz, who Iran control and manage, they shut that. What happened then is, obviously, oil prices went through the roof, because oil, which 20 million barrels per day comes out of the strait, was basically stopped. So there is still oil in circulation out there. I think it takes at least from the strait to the US. I think it takes at least, I don't know, I think it's like 8 to 10 weeks for the tanker to eventually get there. Obviously, they leave in advance. So the problem was, the longer this was going to go on, the higher oil prices were going to get, because it was a supply issue, right? Think about supply and demand. What we had for sort of the entirety of 2024 and 2025 was a decrease, an increase in supply. Okay, so you would see them basically increasing the amount of barrels being produced per day across the OPEC plus countries. And what that was doing, it was driving oil lower. Up here, when Trump was inaugurated, he just turned around and said, drill, baby, drill. They're going to start producing more oil as well. So this is WTI, obviously. And we can see that prices went down. But then there was a supply shock. Okay, so suddenly all that supply that's been pushed out there has stopped. Okay, so now demand comes into it. Less supply equals more demand equals higher prices. Prices have rose off the back of that. Adding to that geopolitical tension, usually in those conditions, the dollar strengthens as well. And that's what we saw. The dollar was strengthening throughout that period of time because of the potential geopolitical risks in the market, which was also causing the volatility index to rise substantially, which then had a knock-on effect on the stock market, which we saw drag lower. Now, that's reversed. That whole situation, for now anyway, has reversed. The longer-standing impacts of higher oil prices, we'll still have to wait and see if it turns from being especially sort of a supply shock to an inflation problem. If that really does happen, then it's going to be a different story, and we probably are going to see stock markets return back to the downsides and all that kind of stuff, because inflation will have a knock-on effect to interest rates. But right now, the peace in the Middle East for 2 weeks as negotiations go on is the catalyst to why prices are doing that. I mean, yesterday, the market was so back and forth. We actually posted in our Telegram channel, which we do have now. If you want to join the Telegram channel, please let us know, and we'll send you the link to do that. But yesterday was a really, I'm just going to put the session breaks on. It was a really kind of up and down day. The market didn't know what to do. What we had was, in the early European session, prices rose because there was a de-escalation news report that came out. And then what happened was, there was a release from Trump basically saying that we could end up bombing Iran today to devastating effects. We then had a little bit of a report that they're in negotiations again. And then what happened here was quite interesting. There was a report that came out that said Iran was not willing to negotiate, and boom, it sent stock markets lower. We then had a bit of a recovery going into sort of late US session. But then as time went on, it was more and more chance that Trump was going to back out of this and that negotiations were going well. And what that saw was price started to rise again. Now, if you're trying to trade this from just a pure technical position, that is so difficult to do. So difficult to do. A lot of traders would have got smashed yesterday trying to trade in this kind of market condition because it was just so flip-floppy back with price action. And if you don't understand the wider scope of what is going on, then it can be difficult to take these kind of positions. And that's why I built the WCS method. You know, it's always about trying to find out what the why is going on, how the conditions match up with that, and how we can look at a strategy to take trades. Okay, so I'm going to leave it there. I hope you enjoyed this webinar. Thank you for joining me. I will catch you in another one very soon. We've got another one coming up with Lindsay. We're going to be chatting all things risk and reward. So please join us for that one soon. And thank you very much. Bye.
On the court or in the markets, performance is everything. That's why Anzo Capital is helping to power your trading game. Now official partner of the Phoenix Suns.